forks, or options. One asks you to be right about one thing, the other, three. Here's the breakdown.
Forex or options, two of the most popular ways retail traders try to grow money, and two products that look similar from a distance and are completely different up close. If you're sitting on a few hundred or a few $1,000s trying to figure out which one to learn, this is the breakdown. The mechanics, the real capital floor, the learning curve, and why one of these only asks you to be right about one thing while the other asks you to be right about three. Start with what you're actually trading. Forex is a directional bet. You're guessing whether one currency rises or falls against another. Symmetric payoff. Buy Euro USD at 1.0900. It drifts up to 1.0950. That's 50 pips. On a 0.10 mini lot, each pip is $1. You made 50 bucks. It moves the other way, you lose 50. Clean, simple math, no expiry counting down. Options are a different shape entirely. You're not betting on price directly, you're buying a contract that gives you the right to transact an underlying at a strike price. Take a $5 premium on an Apple 200 call 30 days out. One contract wraps 100 shares, so your premium isn't 100 bucks, it's 500. Apple rallies to 220, your call is $20 in the money. Net P&L, 1500. Apple stays flat or drops, the whole 500 is gone. That's asymmetric, bounded loss, large upside for the buyer. And here's the mechanism nobody explains. You're not really buying direction, you're buying optionality. And optionality bleeds every single day. That bleed has a name, theta. And that's the trap. Forex hands you symmetric P&L. You only need to be right about one thing, direction. Options give you the prettier payoff shape, but you have to be right about direction, timing, and volatility. Three variables, not one. Which is why options have a steeper learning curve, why options demand more capital, and why most beginners who jump straight into them get crushed. We'll unpack all three. Capital first. Forex is the cheaper entry. Most brokers will open a live account from 20 bucks. Micro lots, that's 0.01, let you trade with pennies per pip. The realistic minimum to actually learn Forex with real skin in the game, $200 to $500. Options are way more capital hungry. Not because brokers won't fund a small account, they will. The reason is structural. One contract covers 100 shares of the underlying. A modestly priced option on Apple, Microsoft, or SPY runs $400 to $1,500 in premium. And if you only own one contract, you can't diversify, you can't size, and one bad trade wipes you. Realistic minimum for stock options, $2,000 to $5,000. Here's the math nobody walks you through. An options contract on a $200 stock wraps $20,000 of notional exposure. If you're using a 1% per trade risk rule, which you absolutely should be, you need a four-figure account just to hold one contract. Forex micro lots scale all the way down to 1,000 units. Same risk math works on $200. That's not preference, that's arithmetic. Then there's the part most beginners underestimate, the learning curve. Forex has maybe 5 core concepts: pip, lot, leverage, margin, swap. Add basic technical analysis, basic macro, basic risk management. A motivated beginner reaches operational literacy in a few weeks. Not profitable, literate. Options has all of that because the underlying still matters, plus a second layer that takes longer than people admit. Calls, puts, strikes, expiries, exercise mechanics, intrinsic versus extrinsic value. The Greeks, delta, gamma, theta, vega, rho, implied volatility, IV percentile, IV skew, term structure, multi-leg strategies and their P&L diagrams, assignment risk and pin risk if you start selling premium, and in the US, tax treatment that differs by product. That's roughly twice the surface area. None of it is mystical, but the time investment is real, and skipping it doesn't save you time, it just relocates the cost into your losses. The traders who blow up options accounts in 3 months are almost always the ones who skipped the Greeks and decided to learn as they go. Now hours. This matters more than people think. Forex trades 24 hours a day, 5 days a week. The London and New York sessions overlap in the early afternoon GMT. That's where the liquidity lives. A swing trader on the 4-hour or daily time frame needs minutes a day. A day trader picks a session and shows up. Options trade during the underlyings hours. US equity options, 9:30 to 4 p.m. Eastern. If you're in Europe, that's 15:30 to 22 CET, your entire evening. Workable, but it eats your night. If you're in Asia, it's worse. That's the practical reason Forex dominates outside the US. It fits your schedule. If you're a European trader with a day job, Forex is the product the calendar picks for you. Regulation. Both products are heavily regulated in Tier 1 jurisdictions. US Forex sits under the NFA, leverage capped at 50-1 on majors, 20-1 on minors, with a FIFO restriction on hedging. European and UK Forex sits under ESMA and the FCA, 30-1 on majors, 20-1 on minors, negative balance protection mandatory. US options clear through the OCC, regulated by the SEC and FINRA. European options trade on Eurex and LSE derivatives venues under MiFID II. The rule is the same for both. Stick to Tier 1 regulators. And here's the warning that pays for this whole video. If you've seen ads for binary options with 90-second payouts, that is not the options product I just described. Binary options are not OCC cleared, not regulated. ESMA banned them for EU retail in 2018. The SEC has prosecuted dozens of unregistered binary brokers. If a platform offers options without OCC clearing, it's a sales scheme, not a derivative. Don't fund it. One more wrinkle, and this one is US specific. Tax treatment. Stock options are standard capital gains. Held under a year, short term, taxed at your marginal rate. But options on broad-based indices, SPX, NDX, Russell, and options on futures, those fall under Section 1256. 60-40 split. 60% long-term capital gains rates, 40% short-term, regardless of how long you held the trade. Mark to market at year-end. For an active US trader in a high bracket, trading index options instead of single stock options can materially cut your effective tax rate. That's a real edge most beginners never hear about. Talk to a tax advisor before you build a system around it, but know it's there. So which one? Pick Forex if you're starting with limited capital, $200 to $2,000. Pick Forex if you can't be at the screen during US market hours. Pick Forex if you like clean directional bets and your edge is macro, technical, or session-based intraday work. Pick options if you have 2,000 plus and want to go deep on one product. Pick options if you're active during US hours. Pick options if you want the bounded loss, asymmetric payoff, and your edge is volatility forecasting, event trading, or selling premium with defined risk. And pick neither, full stop, if you're expecting to live off trading income within months. The 15 to 30% of retail accounts that end up net profitable took years to get there. The other 70 to 85% lose money. If you're trading on tips or guru signals, both products will eat you. 500 to 1 leverage on Forex is gambling. Selling far out of the money options before earnings is picking up pennies in front of a steamroller. Remember, one variable versus three. Forex asks you to be right about direction. Options asks you to be right about direction, timing, and volatility. That's the whole game. The honest path. Paper trade both for 4 to 8 weeks. Pick one. Commit for 6 to 12 months. Switching every quarter keeps you a beginner. Start with the smallest possible live size. Journal every trade. Treat the first 6 months as tuition. The product matters less than the discipline. A patient options trader running defined risk verticals and a patient Forex trader running 4-hour swings can both make it. Neither one gets rich quickly. Anyone telling you otherwise is selling something.
Forex if capital is tight. Options if you can trade US hours. Full breakdown linked in the description.